Hey, yo, what's going on right now? You're watching Casino is the Name, and in this video, I wanted to talk to you guys about some things about real estate that I know not a lot of people seem to know, and these things can make you a very, very rich and wealthy person, okay? So I'm not gonna cover any of the basics about talking about rent and things like that. Well, not in its, I guess, entirety, okay? I am gonna mention rent, but I'm not gonna really talk about rent, okay? I'm gonna talk about some other things, right? Some things that I don't really hear people talk about. And in the conversation that I was having, most of my videos come from conversations that I was having with somebody. And in this conversation, this person was a very, very high net worth individual, making about $1 million a year. And they're trying to figure out what they should do with some money because they know taxes are gonna kill them. You know, every year they say they're paying about $400 and some thousand in taxes. And they was just wondering some things that they can do. And they were hearing some things from, you know, they have accountants and CPAs. And if you don't know, I am an accountant, right? But there is still a difference between, say, an accountant, someone who invests, someone who, does financial planning. There's still like a lot of differences, because just because someone is an accountant doesn't mean that they're like investors or things like that. You may be able to learn some things from an investor that you don't, that even that accountant doesn't really know, because they haven't had to deal with that directly. Sometimes just experience gives people more information than, say, somebody who went to school for it or whatever. Or, you know, or read about it but didn't practice it, okay? So they were saying, hey, you know, I know you're an accountant, but you're also an investor like I am. So what do you think about this? And what I realized in that conversation, this person made a lot of money, way, way more money than me, okay? Like over almost 5 times what I make. So, you know, talking to this person, I realized quickly, because basically I said, oh, well, no, because they made a statement about should they go buy this or should they go buy that? What would I suggest? And I said, oh, well, you should buy a house. And it was like, but why? Like, why would I do that? What sense does that make? It's just another house. And I said, oh, you don't. I said, well, so you can depreciate, you know, so you can tax defer, like, well, you put that money in that house, and you spend $200,000 on the house, right? And then spending $200,000 on the house, you turn around and you rent the house out, okay? So whatever you rent the house for almost don't matter. But let's say you got a $200,000 house, and then you do a cash out refinance, you pull 80% out, right? Because let's say on 200,000, you know what? Maybe we should use $1 million. No, let's just do 200,000. All right. So on $200,000, okay, put too many zeros. So on $200,000, let's say this person is saying that they want a 45% tax or whatever. So that same $200,000 sitting in your account times 0.45, they're going to tax you at $90,000. So that's 90,000 minus 200,000, which would leave you with $110,000. So if you had 200,000 and you were in the 45% tax bracket, you would be left with $110,000. They would have taken $90,000 from you, okay? Now, if you just took that same 200,000 and put it into a house, like you bought a house that was $200,000, you can then go to the bank and do a cash out refinance, right, of 80%, up to 80% of whatever the home value is. So if the home value was 200,000, you can do a cash out refinance and pull $160,000. You can pull that out and they'll give you that $160,000. And I'm not even going to go into the reason why it's 80%, but just know it's 80%. You can do a cash out refinance of 80%. And will that have an interest rate? Yes, that will have an interest rate. You will pay interest on that $160,000, which is why you have a tenant. This is why you have a tenant in the house. And you rent it to someone for actually more than what your mortgage is. So let's say your mortgage is $1,000 on that house. $1,100 on that house, let's say something like that, $1,200, you rent the house at $1,700, $1,800, $2,000. whatever it is. Let's say 1,800. You rent the house for 1,800. You're making a profit, so you're actually cash flowing, and they're paying your loan for you. So you get the $160,000, which is $50,000 more than $110,000 that you would have got for being taxed on it. So you actually walk away with $50,000 more than you would have. Plus, someone else is paying the loan off. It's helping you build credit. Also, you're cash flowing from that same amount of money. So you're actually making more money than you would have. So let's just say it was a 30-year mortgage and you cash flow $500 a month times, and then we're going to use, let's use $400, okay? Let's say you cash flow $400 times 12 months times 30 years. So you would have made another $144,000 off that same money. So you would have been $50,000 up. You'd have made another $144,000 from rents. And I use 400 because let's say you were actually renting at 1900 on a $1,000 mortgage. Let's say everything balanced out to really about $400 if you had to like put a roof on it at some point or whatever. But you'd have made another $144,000 profit over 30 years just by holding the asset, on top of the $50,000 that more than letting taxes take it, right? So you'd have made about $194,000, $50,000 plus 144. Plus, when you look at depreciation, so let's say you're making more money on your taxes, right? Like say you're a $1 million net worth person. Now you can depreciate the value of that house by 27 and a half years because it's rental property. So that $200,000 that you originally spent, you can now divide that by 27.5 years, and now you can take $7,272 off of your taxes every year just by having the house. So whatever your profit was, however much money you make, you also get the benefit of depreciating $7,200 per year. Or you can do accelerated depreciation, where you can depreciate a larger amount, depending on if maybe you need to depreciate a whole lot of money one year. You can use an accelerated depreciation and depreciate more money than that, to shorten the amount of years of depreciation. But anyway, so you get the benefit of depreciation, right, to reduce your taxable income. You get the benefit of over 30 years, almost $200,000 difference. Well, with depreciation, it would be over $200,000 difference. But you also get the benefit of the value of the house growing over time. So let's just say my house doubled in the last 6 years. That's not normal, right? But let's say in 30 years, we can expect the house to be at least double, really probably like triple what it is now. But let's say in 30 years, that house goes from $200,000 to being worth $450. Okay, let's just say $400. That's still another $200,000, and then you turn around and you can sell that house. You can do another cash out refinance, because remember, the house is paid off in 30 years. Right? Because that's the mortgage is 30 years. So the house is paid off in 30 years and somebody else paid it. You cash flowed the entire time, and rent went up, with inflation and stuff. So, but you cash flowed the entire time. Now you turn around, you got another $400,000 sitting there. Okay. Now I know you're talking about 30 years and stuff like that, but remember, if you're a high net worth individual, you can do this repeat. You can have hundreds of houses. You can have 10, 15, 20 houses. You can do this as often as you want. If you make a large sum of money, my suggestion would be to go do this process, to go drop the money in there. And now whatever else you do, remember, you're working with a profit above what the government would have allowed you to have in the first place. Now you have these depreciating assets, so you can depreciate your taxable income. And then you also have the added benefit of appreciation. So you have depreciation and you have appreciation, and it's a win-win. It doesn't make sense to do almost anything else if you need to reduce your taxable income. Like you have a large lump sum of money. I don't know why NFL and NBA players aren't doing this every day. Like just, I gotta buy a house, because now they can just spend the same $200,000, same $1 million. You got $1 million, buy 5 houses. and then do a cash out refinance and rent them all out and let the tenant pay your loan back, take more money than what the taxes would have been what allowed you to keep, and benefit from depreciation over time and the appreciation over time. You get it? Anyway, I just want to come on here, talk to you guys about that real quick, because I realized in talking to this very rich person that I know, this very well-off person that I know, this millionaire, and they didn't understand that part. And I said, oh man, there must be a lot of people misunderstanding this. If you got anybody that you guys think that, might benefit from a conversation with me about just certain things, please reach out to me. Hit me on Instagram at @KingCasino1. Let's have a conversation. Let's build. Let's grow. Anyway, right now you're watching Casino Is the Name. Like, share, comment, and subscribe, and we are out.